Welcome back to Good Revenue. Today, we're going to share the second half of our recent interview with Michael Frankel of Trajectory Capital. If you're interested, we released the first half last week. Thanks for listening. Switching gears, how do you see this market affecting strategics? And what do you think their approach will look like going into 2025 and beyond?
So I think, particularly when it comes to M&A, strategics are going to walk that line between not wanting to miss out on opportunity. And for them, opportunity is also a threat, right? The opportunity to enhance your business with AI is also the threat that your direct competitor enhances their business with AI. They will be highly sensitized to that, but they are also risk-averse institutions. And so I think we go back to our earlier conversation, the more uncertainty there is about the market, the more caution is going to get infused that will balance out the over-enthusiasm. And then I think you get to industry sectors, right? So I think the answer, those are two general themes, but I think you'll get to specific industry sectors where things are either moving hard, fast forward, and you need to be aggressive, or where you can afford to be more modest and conservative. It depends on whether your particular subsector is getting radically disrupted right now. I think that right now, I would strongly suspect as we just get toward the holidays, across large corporations globally, but especially in the US, there are all kinds of year-end strategy exercises trying to run scenarios, number one, on what the new federal government's going to do, but at the same time on what's happening with new technologies, where can we apply them? Getting back to an earlier part of our conversation, I think the rigor of ROI targets for new and technology investments is ramping up very quickly. I suspect that 2 or 3 years ago, there was a lot more enthusiasm for, we should really be pursuing Gen AI. Let's put together a project. I think that, if you will, that dialogue, which was headed by the innovation leader and the strategy leader with the CEO, I think over the last 12 months, 18 months, the CFO has appeared in that conversation and sort of said, okay, listen, I understand this is very important, but where's your P&L? What's the return going to look like? What are the risks, the payback period? Why aren't we doing enough in AI? And now it might be, okay, how is this affecting our earning per share? I think strategics are going to have a period of a lot of introspection and navel gazing. I also think for a lot of strategics, not all of them, but a lot of them, they have line of sight to fundamental disruptions of their business model. And so they are struggling with how to address that. A lot of that could be organic, but I think a lot of it could also be M&A. M&A is a tool for getting things that either you can't build yourself or that you want faster than you could build yourself. And I think that urgency is going to drive a lot of M&A activity.
Later, but to your point, M&A there are lots of reasons, but in theory, it's to fix a business problem, although maybe empire building. In some organizations, two of the reasons are growth by revenue and growth by IP. Mm-hmm. What is your sense of that, again, in this kind of forward-looking where there's just so much that's just not known?
I think you're still going to do both. I think that it's easier to do growth by IP in an uncertain environment as long as you're certain about the IP. If I know that my industry is going to evolve through the use of Gen AI, replacing a whole chunk of my functionality, and I'm certain that's going to happen, it doesn't matter what the economy is doing because that's a existential threat to my business. So in that case, I may try to be more aggressive or less aggressive in valuations and things like that, but I have to do it. It's not optional. It's a way of protecting my business from ceasing to exist. I think the motivations from growth by IP are going to remain the same and probably accelerate, at least in certain sectors where there's a lot of technology disruption right now. Growth by revenue, I'll give you two answers. One is companies should be more cautious in an environment where they don't know what the near-term economy looks like, because a growth by revenue strategy M&A strategy is a build by definition, right? These are things I could otherwise build. Paying a premium for them now is premised on the idea that will lead my overall company to perform better than it would otherwise. And that may not be a reasonable assumption if we go into a declining market. So if we go into a recession, we would have wished that we'd pursued the slow, steady build strategy versus the buy strategy. Part of the problem with that, though, is it is very hard for companies to predict decline. There's a natural psychological bias to say, we're never going to decline, right? Because no board ever wants to hear that, even if it's reality. In my experience, a lot of management teams will reverse engineer from what does the answer need to be? And then that is our prediction. So as a result, if you then buy your own baloney about, of course, we're going to keep growing, even if we're going into a recession, we'll find a way to grow, that then motivates you to go, well, therefore, we're still going to continue our robust M&A strategy. So unless you have a disciplined board and management team that's willing to be realistic with themselves about the threat, it's hard for that to be a damper on M&A, if that makes sense.
Yeah, I think you're alluding to a classic inside view problem for most companies. And again, for all of us, because we're humans, right? I think most observers think that the regulatory environment will become more conducive to acquisitions, particularly by larger strategic acquirers. At the same time, it seems like maybe Lena Khan is still going to stay at the FTC. She does have some supporters in Republicans. I tend to think that the new administration will bring in a new cast of characters entirely. That's what I'm questioning. If you still in your prior role as a corp dev person, how would you be evaluating the opportunities given what might?
So let me separate antitrust from all other regulation. I think that a looser antitrust regulation is going to be an incredibly powerful change for an incredibly small number of transactions. Now, they're really high profile transactions, but statistically, I don't know what the number is. Let's start out with a significant percentage of all M&A is exempt from even having to file HSR because it's too small. And then even among the transactions that do, I don't have a number, but I would be surprised if more than, I think we would calculate the number of M&A transactions that were actually blocked by the federal government in basis points of the total volume of M&A. So for certain deals where there's consolidation at a very large scale, it can make a difference, but I don't think it moves the M&A market because the M&A market, for the most part, is immune to those kind of barriers. I think it'll have an impact on a small number of mega corporations and their strategies. And my impression is that the current HSR process is not a particularly arduous process. So I don't think anyone is not doing a deal because of those filings. So I think antitrust, I just don't see how it actually changes the overall world, especially when you drop below the mega deals, when you drop below just truly massive deals by truly massive companies. And then other regulation, I think it has an incremental impact, but frankly, I don't think any regulation that I've seen, I think it's rare to see a case where you have a perfectly attractive, economically attractive M&A transaction and you stop it because of securities regulation or commercial regulations. I think that change it'll have a big cultural change. It'll drive a big change in the way companies operate, right? If you slash lots of regulation, you're going to reduce costs within the company. You're going to change operating behavior in a variety of different ways. But I don't think it's going to be a major tipping point for M&A specifically, especially once you get below mega deals. I don't think a change in antitrust regulations causes a seismic change in what they do. It may cause a few more mega deals. I don't think that's the downstream force that I think is most powerful. I think the downstream force that's the most powerful is the point we were making earlier, if they start using their dry powder more aggressively. So if one of those big tech companies has an internal strategy conversation that says, it's really important, as an example, that we verticalize all of our AI capabilities. That means we need to do acquisitions across 20 different vertical areas. So we have a big AI engine and we want to apply it to oil and gas supply chain and to hospital inventory management and to retail customer experience, whatever it is. And therefore now we're going to run around buying those solutions because we've now determined that we need specific use cases for our AI capability or our Gen AI capability, that kind of strategic decision will have a massive down market impact, because when the big players start running around and buying more stuff, they, number one, create scarcity. Number two, ramp up valuations because they have synergy, so they can afford to pay. Then there's an even further downstream effect, which is it then generates a wave of new investment, right? Because at the earliest stage of the ecosystem, the seed funding world and the young entrepreneur world, the more M&A in the market, especially high price point M&A, the more inspired you are to go be an entrepreneur. I think those are the down market effects. But I just think antitrust is, I haven't gathered the data, but I would be surprised if it was different. This is just not doesn't block a large volume of M&A. So if you eliminated all antitrust regulations, you might see a fairly seismic shift. I just think that's relatively unlikely to happen. So I think it'll have an effect, but I think the effect will be swamped by some of the other forces we've talked about, like lowering interest rates, like a perception of stability or instability in the market, like the emergence of AI and real ROI use cases for AI.
So switching gears, in the middle market, what role do you see PE playing versus strategic? So deal around 500 million or less.
So I think both always have a role. The interesting dynamic between the two, especially in what I would call a normalized valuation environment, is that strategics have the secret weapon of synergies. In a normalized market, strategics should generally win because they have this extra chunk of valuation. I'm always suspicious of private equity that acquires an asset in a competition with a strategic, because my question is always, what is it that causes you to think you can exceed their synergies without the synergies, right? So you have to really think that there are inefficiencies in this business that you can fix that they weren't able to fix. There's always room for both sets of players. Whenever you have a target company, the natural buyer is the buyer who can create the most added value. So in some cases, you have an asset that will create the most added value when put inside a large strategic. An extreme example would be a fantastic product that every customer wants, but customers are annoyed that it's not part of a broader product platform. That would make them buy it a lot more. And the company is terrible at selling. That sounds like a perfect fit for a strategic. You'll make it part of a broad platform, and the strategic will bring in their world-class sales. By contrast, a scenario where it's a great business, but it's too subscale for strategics to be interested in it, or it has a bunch of broken stuff that needs to be fixed that scares strategics, and so somebody needs to come in, or it is the natural platform for a roll-up. And that's really the biggest value creation opportunity. Is there are 120 of these things, and if you take 10 of them and slam them together, you're able to cut 70% of the costs. Okay, now that sounds more like a private equity deal. I always go back to basics. How do I take a business that's here and get it to here? And who has the right capabilities to make that journey? And what are those capabilities, right? Is it scale? Is it other products? Is it operating agility, which private equity has much more than strategics? So I always look at those dynamics. In the coming years, it's going to be a little bit of a scary and interesting mid-market because you have a couple of forces colliding at the same time. To our earlier conversation, you have a lot of dry powder. A lot of private equity funds have been raised and they need to deploy. That isn't necessarily a bad thing, but it can lead to bad behavior. And the flip side is you have corporates that also have a decent amount of dry powder, and in a rapidly moving environment where they need to make changes, M&A is when used properly, a phenomenal shortcut. We need to get from point A to point B. We can do it organically, but it'll take us 4 years, or we can buy. And so I think you're going to see a potentially frothy market in some segments. I think the segments that are going to have froth are larger end of the mid-market, right? Above 10 to above 20 million of revenue. Below that, you have a lot of players that drop out because the check size is too small. Strategics who don't want to buy something really small, PE funds that can't afford to write a really small check. But once you get up above, call it 20 million of revenue, I think you're going to see a lot of competition between those two forces. And I think it'll be particularly acute in certain market segments. So I think almost anything that's powered by AI or Gen AI, almost anything that speaks to health, wellness, depending on global stability, maybe cyber rolls into that space as well, because it gets a lot of attention and a lot of focus. There are going to be certain areas where there's going to be strong strategics, eager to buy, strong PE with a lot of capital, eager to buy, a lot of perception of higher value, a lot of high VC expectations because they were investing in these companies over the last few years at high multiples. And I think there's a real danger that part of those little bubbles get really frothy.
That's a super helpful breakdown. Thank you. We have also seen an uptick in companies being taken private by PE firms. Sense of that. Do you foresee that trend continuing? Where can we go from there?
So I do think it's going to continue for a couple of structural reasons. The first one is the larger a PE fund gets, the larger their average check size has to get. It's just economics. And a lot of the largest targets in the world are public. Because that's when you naturally go public. That doesn't mean there aren't large private companies, but if you need to write multi-billion-dollar checks, statistically, a lot of the potential targets are public. A little bit of decline in regulation might help in terms of the logistics and the cost of taking a company private. Although if they're big enough, it gets swamped by the size of the deal. So I think number one, there's an incentive on the part of the larger and larger private equity funds to target public companies. Number two, public company valuations can be, I don't want to call it irrational, but they're not controlled by the management team like a private company valuation is. There are market opportunities where if a stock has slid, you can come in at a really attractive valuation. If it's a private company, they have the ability to say, we don't care what the markets are doing right now. We think we're still worth $1 billion and we'll just say no to your offer. A public company can say no to an offer, but it's a lot harder because it's public and you have pressure by the shareholders. I think the last force is you've seen a lot of companies go public over the last decade that maybe shouldn't be public. They're either too small to be public or they have economic dynamics that don't lend themselves to a quarterly reporting model. And maybe some of them have discovered that and realized that they can create more aggregate shareholder value as a private company. That public to private dynamic is going to continue. I can't tell you volumes, but I don't think it's going anywhere.
What about a more storied company? One of the firms that's been in the news a little bit lately has been Target. It's obviously a very well-respected, recognized brand, but also a firm that's really struggled in recent years when some of its competitors like Walmart have succeeded. Do you think something like that is also a target in this environment in terms of being taken private?
There's no industry sector that can't be the target of a private takeover, of a private equity. I don't know anything about that specifics. I'm definitely not a retail expert, but I think anybody is fair. If they're underperforming, it's a combination of the stock's got to be underperforming coupled with somebody sees a light at the end of the tunnel. Some private equity fund that they think they can. And that can also take multiple forms. It can be a take private. It could also just be an activist investor. I think if anything, people are becoming more adept at navigating the complexities of engaging with a public company. I think there are a lot of firms out there that are world-class experts at it and are not scared at all. In fact, that's their bread and butter. And that's been going on for a long time, since the 80s. It's become more of a well-defined skill set. And there's a whole population of people who do it for a living now.
Super. Okay, last topic, and then one of the things we wanted to get into was the fact that many more PE and VC firms have been their credentials when it comes to value creation and their capabilities. And I know this is a topic of interest to you as well. How much value creation do you really think is happening?
I find the term value creation and the term portfolio operations frustrating because there's no certification for this, right? And there's no validation. And so anyone can say that they do it. I think there's a wide range of capabilities. Start with almost every fund wants to say they do value creation. It's a pitch to both the companies in which they invest and to their and if you think about it, it's obvious. What sounds better? I buy things and then I wait for someone else to want to pay more for them, or I buy things, I make them dramatically better, and then I sell them. The second
it's
one
existential, right?
Yeah,
right.
It sounds like I'm earning my money. And the second case is being a hobby. So everyone says they do value creation. In my experience, there are multiple archetypes. There's the value creation that is really just very senior and semi-famous operating partners who provide what I would call high-level guidance at the board level. And that's it. The second model, the vendor model, where we don't provide value creation, but we've pre-vetted a whole bunch of vendors and they'll provide the value creation. And that's consulting firms and things like that. The third is what I'd call the really junior value creation team, which is we have a value creation team, but they're basically almost facilitators of the vendors. They can do basic stuff, but it's like a shared, so they can do SEO marketing for you or things like that. And then the last version is what I think of as true value creation. And that is where you have, number one, dedicated humans that are actually expert operators and will get in the weeds. So they don't sit at the board level. They go down into the weeds with a portfolio company team and help improve parts of the operation. And then the second piece is what I'd call the intestinal fortitude to do value, because true value creation requires hard choices and hard conversations. It requires you to actually change things about the business, as opposed to being helpful when you can be. If your version of value creation is, if they call and ask for my opinion, I'll give them my opinion, that's not value creation. That's just being a helpful investor and board. True value creation is going to include changing things, firing people, potentially firing customers, pivoting in different directions, adding more resources. It's real work. So I think next gen investing almost always should have a value creation component, maybe with the very, very small deals where it's too early to do any value creation. They're still trying to figure out what the thing is, and very large deals where the company is so big, they can basically afford to hire the same quality of people you'd have on your value creation. And therefore, just give us extra budget because we're just going to bring those people in-house. But I think everything in between needs value creation. And it's like one of those terms that sounds fakey wakey. It is so fundamentally true. I think a lot of people who aren't in business assume that businesses are monoliths that operate like mechanical machines, and they're either properly tuned or not, but if they're properly tuned, they just run forever. And you and I know the reality is businesses, especially smaller businesses, often don't have a full suite of executives that know exactly what they're doing. They haven't encountered problems before. They haven't had to scale before. And so I think for those businesses, real hands-on value creation can make a dramatic difference in the outcome of the company and the investment. So I'm not talking about a 3% difference in outcome. I'm talking about a 50 or 70% difference. It can be the difference between success and fail. I think that value creation is going to become a standard part of the playbook, and in some ways almost eclipse, which may sound anathema to everything I do for a living, may almost eclipse entry point valuation as a driver of investment performance, right? It's not to say that everyone doesn't want to invest at an attractive price, but especially in a world of competitive pricing, your ability to get a better price than somebody else's is a lot less than your ability to wrench on a business and make it better after you get it on board.
Yeah, and it almost like what you're also saying, or what you're arguing, there's a transformative contribution on the part of that value creation strategy on the part 100%. Of the you are saying this because it's more than the 3%. You thought about, but if you're an LP, how do you know that this is real?
It's a huge, I don't envy my friends who are LPs. It's incredibly hard because it's so easy to do jazz hands on this stuff.
Yeah,
right?
Totally.
So I think the answer is...
And to take credit for something that would have probably happened anyway, right?
That's right. Now, if it happens over and over again, if you're able to make it magically happen, I don't care if your value creation is fake because you figure it out. Say, as a general matter, the way LP suss these things out is, number one, evaluate so do you actually have humans on your team that you can show me that I believe have operating expertise? if your portfolio operations people have never operated a business or are 24 years old, then no, I don't believe that you're doing hardcore portfolio operations. So first you have to show me the humans. And then if I really want to get into it, show me the play, show me the pivots that those businesses have made and how they have contributed to the app. Now, to your point, do I know for sure that was done by the portfolio operations team? No, but I don't care. So if you show me an operating executive who's a world-class go-to-market executive, and then you show me a 3-month plan for restructuring the sales org where we're changing roles and we're separating account success from customer success from new account acquisition, and we're changing the comp met, and then you show me how sales have ramped up and mugs to close, days to close has reduced, I'm going to give you credit for assuming that those people you showed me before who are real experts in go-to-market had a hand in that, right? And if they really didn't, then hey, I mean, you're still achieving the goal that I want. But that, I think LPs have got to dig in way further than just, oh, you do portfolio options. Oh, that's, yeah, check the box on that. Who's doing the portfolio operations? How are they doing them? And then show me the results of that work. And ideally, show me the results that have actually borne. And LPs, I think, are getting more sophisticated at that, just like they've gotten very sophisticated financial returns, right? Risk-adjusted financial returns. Show me how those have evolved in your portfolio. I think they're going to get more sophisticated in this. And I think it's good because at the end of the day, it's one of the few areas of the investing world that isn't a net zero gain. So if I can buy your company for 10% less, I haven't created value. I've just taken extra 10% out of your pocket, put it in mine. Same thing on the sell side, right? If I can sell it to you for $10 more, then I got $10, you got $10 less. But value creation, it's making more value. It's making a business worth more to everyone. It's a win. So I really like that part of the action. And I do think that mid-sized businesses can seriously benefit from it. Now, that will say, I've heard all kinds of horror stories of private equity investors who don't have operating experience trying to do value creation and doing the same reason I don't do my own dental work is the same reason that's a bad idea.
You mean operations by spreadsheet doesn't actually work in the real world?
Operations by spreadsheet or operations by goal or even operations based on, I think this should work. I've never seen it work, but I'm smart and it seems like it should. Yeah.
Michael, this is why we love you. Is there anything else that you wanted to cover today?
So the only other thing that I'm observing that I think is really interesting is there a shift away from other technology businesses towards AI businesses that I think is overplayed. And I think that, and we've seen it with other new technology trends where when a new technology, everyone shifts to it and they shift away from other technologies. And I think now it is true that sometimes one technology displaces another, but I think oftentimes it's additive to another. So if you had a BI tool and now you can web enable it, or you had a SaaS platform and now you can move it to the cloud. So I think it'll be really interesting to see, but I strongly suspect that a lot of the more traditional information services and software businesses will effectively use AI to enhance themselves and become incredibly powerful businesses in the future that didn't get the majority of the capital because everyone was focused on pure play AI.
What a great place to leave this. And it really seems like we're full circle. You had raised earlier when we were talking about AI agents, maybe more enterprise vest outcomes that like aren't the sexy things to sell necessarily, right? But that's like the world operational improvements and incremental value that really makes a big to a company, especially to a larger and established firm. So,
oh yeah,
I think
I always say the most sexy thing to me is ROI and IRR.
This is why we're nerds and we love it. I totally agree with you. Thank you so much for coming back, Michael. I enjoy having you here and hope to see you again soon.
Yeah, this was great fun.
Thank you.
Thanks so much for listening to Good Revenue. If you liked what you heard, please subscribe to the show, give us a rating, or leave us a review. It helps other listeners find us, and we really appreciate your support. You can also catch full videos and highlights on our YouTube channel.